Welcome to Tech Money Madness, your daily U.S. stock market podcast, July 10th, 2026.
Glad to be here for today's deep dive.
Yeah, so today, we really have a massive contradiction on our hands, and we're going to unpack it for you all.
Oh, absolutely. It's a huge disconnect.
Right, because you look at the U.S. macroeconomic indicators right now, and they are basically flashing these bright red warning signs of a severe slowdown.
Flashing red is almost an understatement at this point,
Seriously.
Right?
But then on the flip side, you glance over at the tech sector and it's just skyrocketing. It's flying on the back of AI. So our mission today for you, the listener, is to untangle this market madness.
Yeah, and we are going to give you a really clear-eyed look at what's actually driving this. We need to separate all the daily noise from the fundamental structural shifts happening right now in cloud computing, semiconductors, and even global trade.
Exactly. Let's start with that macro picture, though, because the broader U.S. economy is facing a pretty sobering reality check.
Very sobering.
According to the latest from CNBC, job creation just cooled off significantly in June. Payrolls grew by just 57,000.
Just 57,000, which, for a U.S. economy, it's nothing.
Right. It's essentially flatlining.
Yeah, and that brought the unemployment rate up to 4.2%.
But here's the thing about that 4.2% number. It's actually hiding a much more alarming detail if you dig into the report.
Oh, the participation rate.
Yes. The labor force participation rate has literally dropped to a 50-year low.
Wow. A 50-year low.
Yeah, assuming you exclude the immediate, weirdness of the COVID era. People aren't just losing jobs, they're actively leaving the workforce. The labor pool is physically contracting.
Which is wild because usually, if the job market is slowing down that much, you'd expect prices to drop too.
You would think so, yeah. Demand destruction.
Exactly. But inflation is still running incredibly hot. The May core inflation rate hit 3.4%, which is the Fed's preferred gauge, right?
Right, the PCE.
Yeah.
And 3.4% is the highest we've seen since October 2023. Okay, so I was trying to visualize this earlier for you guys listening. It's like the U.S. economy is this car, right? And the engine is just totally sputtering out because of the low job growth and shrinking labor force.
I like that analogy.
But at the exact same time, the temperature gauge on the dashboard is flashing deep red because the engine is overheating from this 3.4% inflation.
A classic stagflation scenario.
Right. So my question to you is, if the engine is dying and overheating at the same exact time, why isn't the broader stock market just completely crashing?
Well, it's a great question, but you have to remember the market isn't just reacting to the U.S. These companies don't operate in domestic vacuum.
Oh, so the global picture is carrying the weight.
Exactly. The global signals are very mixed right now, and some places are actually stabilizing. Take the UK, for instance.
Okay, what's happening there?
So UK inflation actually held completely steady at 2.8% in May.
Oh, wow. That's significantly better than our 3.4%.
Right, it is. And because of that stability, the Bank of England was able to hold their rates at 3.75%. So you have some predictability over there in Europe.
And I'm assuming the geopolitical stuff plays a role too, right?
Huge role. We're seeing really strong prospects for a peace agreement in the Iran war.
Right.
And when you take the threat of massive supply chain disruptions and oil spikes off the table in the Middle East, institutional capital breathes this huge sigh of relief.
Okay, so that stability kind of creates a safety net for investors, but it doesn't entirely explain why certain stocks in the U.S. are just going ballistic. Big tech is basically keeping the U.S. market afloat by itself.
Oh, completely. It's doing all the heavy lifting.
Let's talk about Apple, because their stock has been on a total roller coaster.
To say the least.
Yeah, but CNBC reported they just posted their first record close in over a month. And it's entirely driven by what they're calling an AI roller coaster.
Yeah, that narrative has completely flipped for them.
I kind of look at Apple right now like a heavyweight boxer,
How so?
Like, for the early rounds of this AI boom, they looked really sluggish. Everyone was saying they were behind Microsoft and Google.
Oh, yeah, the consensus was that they totally missed the boat on generative AI.
Exactly. But then they just landed this massive AI-powered uppercut by integrating it directly into their devices, and it completely silenced the doubters.
The brilliant strategy, honestly.
Yeah.
And the reason this matters so much for you as an investor is because of Apple's sheer market weight.
Right. They're so massive, they skew the whole index.
Exactly. Apple is so heavy that their individual success can literally mask all that underlying economic weakness we were just talking about. When Apple surges, the S&P looks healthy, even if the rest of the economy is sputtering, like your car analogy.
That makes total sense. And it's not just Apple doing this, obviously. Meta Platforms is another huge one right now.
Oh, Meta is having a massive moment.
Yeah, CNBC highlighted that they just delivered this crazy 18% rally.
Which is billions of dollars in market cap added almost instantly.
Right. But the interesting part is, this wasn't driven by their social media ad revenue, was it?
No, not at all. And that's the key takeaway here. This 18% rally was triggered entirely by cloud news.
Wait, really? Cloud? I still think of them as just Facebook and Instagram.
A lot of people do, but Wall Street is waking up to their infrastructure. Meta is integrating so deeply into cloud computing and running these massive, highly efficient AI data centers.
Oh, so it's signaling even more growth potential outside of just ads.
Exactly. They're being valued as a cloud and AI powerhouse now.
Well, that kind of leads perfectly into the next layer of this, which is the hardware. Because, the software and the cloud stuff from Apple and Meta, it doesn't exist without the physical silicon making it all possible.
A physical layer is where the real money is flowing right now.
Yeah, and the numbers are just staggering. I was reading this report from the Motley Fool, and they pointed out that ARM Holdings stock soared 224.4%.
In just the first half of 2026.
In 6 months, over 220%, just for providing the AI infrastructure.
It's an incredible run.
But, okay, let me push back on this a little bit. We all know the classic analogy, right? In a gold rush, you don't buy the gold, you sell the picks and shovels.
Right, the infrastructure play.
Yeah, but if the shovel company, in this case, ARM, is up 224% in half a year, aren't we massively overvaluing the shovels? Or is this gold mine really that deep?
It's a completely fair question. A run-up like that makes anyone nervous. You're pricing in a decade of perfection at that valuation.
Exactly. One bad earnings call, and it could tank.
Right. But if you believe the gold mine is deep, you don't necessarily have to buy the most expensive shovel. You look at other parts of the supply chain.
Okay, like who?
Well, the Motley Fool actually pointed to Micron Technology as the strategic play here.
Micron? Didn't their stock just take a hit recently?
It did, yeah. They experienced a share price dip. But that's exactly the point. While ARMS skyrocketed to this crazy premium, Micron dipped, but they operate in this exact same critical sector.
Because they make the memory chips, right?
Yeah. Exactly. High bandwidth memory. You can't run these AI processors without the memory to feed them data. So based on their strong fundamentals, the Motley Fool is arguing that Micron represents a really compelling buying opportunity for investors who want an entry point into AI without chasing ARM's massive premium.
Oh, that makes a lot of sense. So you still get the AI hardware exposure, but with maybe a bit more of a safety net.
Precisely. You're buying the wheelbarrow instead of the shovel, and it happens to be on sale.
I love that. So just to recap the market move as we've covered today for you guys, we are looking at Apple, Meta Platforms, and ARM Holdings as the top gainers really carrying the load.
Do all the heavy lifting.
Yeah. And it's important to note, the data we pulled today didn't even bother highlighting the top losers or the most active outside of tech.
Because it almost doesn't matter right now.
Right. The AI narrative is just that dominant. It's completely concentrating the market.
And if you look at the sector trends powering these companies, you understand why the market is ignoring everything else.
Let's get into those numbers because they are huge.
Oh, they are. Globe Newswire just projected that the edge AI semiconductor market is going to reach a staggering $151.3 billion by 2035.
$151 billion. That's wow.
Yeah, and that represents a compound annual growth rate of 19.57%.
Almost 20% growth every single year for a decade.
Right. And remember, that's just edge AI, putting AI processing directly on devices instead of in the cloud.
So basically replacing every chip in every car, phone, and fridge with an AI chip.
Exactly. It's a total hardware replacement cycle.
And it's not even just the heavy enterprise stuff, right? The niche markets are exploding too.
Oh, absolutely.
Yeah.
Generative AI isn't just about writing code or text anymore.
Yeah, I saw the data on the music industry.
The music data is fascinating.
It really is. The generative AI and music market is projected to grow from $0.44 billion in 2025 all the way to $1.34 billion by 2030.
Which is a 23.9% compound annual growth rate.
Over 23%. I mean, we're talking about algorithms writing and producing commercial music. It just shows how deep this AI wave is penetrating into everyday life.
It does. And it brings us right back to the central theme of today's deep dive.
The great disconnects.
Exactly. The glaring disconnect between Main Street and Wall Street.
Yeah, because on Main Street, you have this massive economic slowdown. We've got a shrinking labor force, right? That 50-year low in participation.
Yeah.
And you've got this painful, sticky 3.4% core inflation just eating away at consumer wallets.
But on Wall Street, it's just pure AI and semiconductor euphoria.
So for the listener who is trying to figure out their portfolio right now, what are the real investment takeaways here?
Well, you have a market that's grappling with all these complex global shifts, like we talked about with the UK monetary policy stabilizing and those prospects for peace in the Iran war.
Right.
But amidst all that noise, the clear, undeniable momentum remains in tech stocks, AI-focused ETFs, and the semiconductor companies building the physical infrastructure.
That's where the capital is flowing, regardless of the domestic economy.
It's
But I gotta ask you, man, given this massive tech rally, how long can this AI optimism actually outrun a 50-year low in labor participation? I mean, eventually, don't you need people with jobs to actually buy the iPhones and the Meta headsets?
Well, I want to leave you and our listeners with a final thought on exactly that to sort of mull over.
Okay, let's hear it.
Think about this. If the foundational human economy continues to cool down, while this AI infrastructure market scales up toward that $151 billion mark by 2035,
Yeah.
we might soon see a market where a company's value is judged almost entirely by its AI computing power, rather than the size of its human workforce.
Oh, wow.
I mean, does a shrinking human labor force even matter to the financial markets anymore if the edge AI and cloud sectors can just continue to generate this unprecedented amount of wealth on their own? It's a completely new paradigm.
That is a terrifying but really fascinating point to end on. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.